Thank you for joining this Yellowstone Advisory webinar. Today's company presenting is Capita, and we're delighted to have with us Stuart Morgan, the Director of Investor Relations.
So hopefully you can see the results presentation deck that we presented just over a month ago. As Alex says, I'll just run through those. If you also want to see a recording, these are on our investor relations website on the capita.com website. Just as a summary for where we are in the first half, the key message that we wanted to deliver was that we were on track for what we said back in March at our full year results, and that 2022 was going to be a year where we delivered on our commitments. We grew revenue, again, incrementally, having grown revenue last year for the first time in 6 years. The experience division in particular did well in winning new work, and has seen an improvement in its revenue profile, and has helped to drive the group book-to-bill number. And the public service division continues to do well, albeit unwinding a little bit from a very good start last year. And both of those divisions are heading in the right direction in terms of revenue. In terms of operational performance, Capita continues to do very well. This was one of the bedrocks of the transformation, the focus on operational performance, and we've maintained that. One of the challenges we looked at in 2022 was that we needed to make sure we were recruiting and retaining people, and also we were very keen on focusing on the employee NPS score we got last year, which was disappointing, and we've seen a big improvement in a half-year survey on that. Profit has grown. We're also very pleased to have delivered positive free cash flow in the year, which is one of our full-year commitments, which we did at the half-year, and it's improved significantly on last year. And finally, the net debt number has significantly improved year on year. Just quickly going through the financial results. As I said, the revenue continues to be stable. Look, we obviously want to improve it going forwards, but it's a good position to start from. As contract losses from 2021 starts to expire and we start to grow the business, with also a positive contribution from the portfolio division. Profits improving, partly because of revenue, but also partly because of efficiencies starting to feed through. As I just mentioned, the cash generated in the business is increasing significantly, and we delivered positive free cash flow in the year. And the net debt, both on a pre and a post IFRS 16 basis, has decreased significantly. So the pre IFRS 16 net debt, that's effectively your financial net debt, stood at 290 million at the half year, with improvement to come. So as I said, in terms of revenue, the losses there are mostly from prior year losses, Carphone Warehouse, 3 UK, Npower and William Hill, which obviously got taken over. We've lost a little bit of what we call scope and volume. So that's work we won in 2021 from COVID. That's all been offset by a bit of a benefit from indexation. Bear in mind that that's only 3 months benefit from on part of our business, so that'll improve or increase as the year goes on. Some transactional recovery in the portfolio division, and then the ongoing benefit from some contracts that we won over the last sort of 12 to 18 months, including the Royal Navy in particular, but also the job entry scheme in Scotland and Northern Ireland Education Authority. So as a divisional financial performance, as I said, the Capita Public Service business has continued to grow, mostly through the Royal Navy contract. Its profit has improved, mainly because of the contract wins, but also as a prior year benefit from a 2021 Ministry of Justice impact. And then cash has also improved for the business, or was good, but there were some prior year benefits. In particularly in 2021 we had a TfL contract that was paying lots of cash. In terms of experience, bear in mind, in experience, revenue declined at about 9% last year. So strong improvement in the experience business. The profit reflects that revenue trend. There were some prior year deferred income releases, which again, year on year, have a bit of an impact. And there was a small impact as we booked a furlough provision, which will also have impacted the portfolio division. Cash obviously was good in experience, and this is from customer collections. In terms of portfolio, again, across the board here, it had a good half, mainly as a recovery from the COVID impact in 2021 and 2020. So revenue's grown, portfolio flattish, but on a good trend as we go through the rest of the year. And cash actually mainly impacted as the travel business grows. It sucks up a little bit of cash, but again, it's in line with what we expected. In terms of the PLC impacts, again, we see benefit from restructuring that's gone away. So something I forgot to mention is that all prior year restructuring, or all restructuring that we used to take below the line, is now above the line. And obviously there's a lot less of it because the transformation is finished. So there's a year-on-year benefit there, but there's also some cost savings that we took out of the head office centre, and that's another initiative that will continue. In terms of the bridge to the reported profit before tax, the key lines here are obviously the benefit of business exits was a lot bigger last year, mainly because there were fewer and smaller business exits this year. There was an impact from impairment of goodwill. This was triggered in the portfolio division as we went through the sales processes in a couple of the pillars there. So those are the like for like reported numbers. So optically it looks a lot lower, but is mainly an impact on the prior year. In terms of cash flow, again, the key takeaway here is obviously that the 12.7 million is a positive free cash flow number, which is the one that we've focused on over the last few years and for our guidance for this year. So sort of moving down from the top, cash conversion has gone up, and that's a trend that we are targeting to improve going forwards. VAT like for like, but that's the last payment that we'll have made this year. Pension contributions declined significantly, mainly because of the one-off pension contributions we made last year. So as I say, strong improvement in free cash flow, net debt improved by 170 million, and therefore that trends significantly in the right direction. In terms of the balance sheet, I think sort of the key things to note here are that the RCF was undrawn at the half year. We extended it with our banking syndicate in August, which now goes out to August 2024. We paid just over 80 million of maturing debt, private placement notes in the first half, and there's 140 to be paid in November this year. And broadly speaking, that means that the sort of a hump of the debt that we needed to get through in 2021 and 2022, as well as in 20, has now been overcome, which leaves a significantly lower amount of debt in the business going forwards. And then financial outlook for the rest of the year, we continue to see that revenue growth trend improving in each of the divisions. EBITDA, the margin is actually likely to go down slightly year on year, but some of the underlying movements in there are positive. Free cash flow, as I said, we are targeting a positive free cash flow at the end of the year, and then net debt will continue to decrease. I think at this point, I will point out that the actual timing and impact and size of the net debt reduction will depend on receipt of proceeds. So when I come on to the disposals later, we are targeting to have agreed, or rather sort of to have launched and hopefully agreed a number, if not most of the disposals by the end of the year. We're not necessarily going to have received the cash for all of those at the end of the year. So you might actually see the net debt number sort of not as far down as you'd hope, perhaps. But our objective is certainly by sort of the half year next year, when we'll have received those proceeds, for financial debt to be non-existent or negligible. Moving on to the main part of the presentation, the first slide is how Capita operates, our purpose. Obviously, ESG is in the last 12 months has become a trend, and Capita certainly has ESG at the heart of what it does. The key takeaways for me on this slide are the board has established a committee for oversight of this, so putting it again at the heart of what we do. It was very good to see the employee net promoter score improve by 16 percentage points. We're poised to do the next survey within the next 6 weeks, so that'll be something we report on at the full year. We continue to be committed to paying the real living wage. That in this cost of living crisis is something we think is important. As I say, I think the Real Living Wage Commission comes out with its report again in the next couple of months, and we'll be implementing that next year. In terms of net zero, the stage we're at the moment, so we're committed to our net zero program, having it in place and done by 2035. The main step for us now is implementing that into our divisional strategies for our budgets in 2023. So again, putting it at the heart of what we do. Elsewhere, we continue to pay our suppliers on time. We continue to engage with people to focus on digital inclusion programs in our communities and networks. As I said at the beginning, we had a good half in terms of revenue and contract wins. We won 1.6 billion of total contract value, so that's contracts that were signed in the first half, most of which will go into the order book. Went up by 4%. We've excluded the Royal Navy training from that and the sort of a couple of the other stats just purely because of the lumpy nature of it. But again, it's a positive move in our view. Book to bill is still positive at 1.1 times, driven mainly by experience, and that was also mainly driven by the BBC renewal, but also by a number of other things. Public service dropped slightly below 1 times, but they had very little actually to bid on in the first half, and they have more stuff coming up in the second half, which will hopefully see that go above 1 in the second half of the year. The overall win rate increased. We continue to be very strong in our renewals at 95%. And again, within the experience division, that was higher still. But our win rate on new business at 42%, again, was a very good number. It's a number that probably fluctuates a little bit, but we're pleased with that. And then finally there, the pipeline increased to 14.4 billion, up from 13.9 billion next year. And again, as we become more established in our new divisions, as the benefits of being focused on clients and client verticals and bringing in that expertise that focuses on certain industries and certain parts of government, that is where we expect to see our pipeline continue to improve, as well as sort of future revenue. So the way we look at our ability to grow revenue is that we have a firm foundation of renewals. You build on that with new scopes of work from existing clients. So you might also call that growth on account. And again, the benefits there are from the improving operational delivery in the last couple of years, gives our clients the confidence to give us not only renewed work, but also more work. And then what will really drive top line growth is our ability to win business sort of out in the open market, so to speak, with new clients. So in the first half, we renewed TV licensing with the BBC. We had a renewal with PCSE for NHS England. We had some new scopes of work with Bank of New York Mellon and the University of Glasgow. And then as we flagged back in March, we were pleased to see the Scottish Power contract. They were actually a client of ours back 8 years ago. But I think we're happy calling them a new client. They've come back to us, but also a nice deal with Allianz Partners in the UK. And then in each of those categories, we have some interesting contracts coming up in the second half of the year. So O2 has been a core client of ours for a long time now. They've obviously had their merger with Virgin Media. So we're in a conversation with them at the moment. Swan, which is Scotland's IT backbone, primarily for NHS, but also for other government services, TfL and teachers' pensions opportunities in the second half. In terms of new scopes of work, again, TfL, we are looking at the extension of the ultra-low emission zone for them. There's a piece of work for the student loans company we're doing, and there's also a European automotive company who we are keen to do some work for. So those are all new scopes of work. And then new clients, again, we have opportunities in the telco sector, the financial services sector, as well as the DWP and Cabinet Office. Technically, they're not new clients, but we see those as separate new bits of work, and we are very keen to do that. Excuse me. In terms of how we're getting to that, as I just mentioned, we're very much focusing on our clients in areas where we have expertise. So on the right-hand side, you can see that our ability to grow the pipeline in the top 5 industries in our business continues to improve. And we're also helping, using our consulting capability, what we call sort of perhaps the tip of the spear, using consulting as a way to build our capability and our credentials will then enable us to build pipeline and pull through revenue in terms of the consult, transform and deliver model that we're adapting. That is also partly supported by being better at defining what Capita does. So this is a business where 5-6 years ago, we had 10 different divisions. There were lots of products that we wanted to sell our clients. And what we're doing now is we're selling our clients solutions using the products and the services that we have. So again, it's the change in the business model where providing a solution to a client need rather than trying to sell a client a product. And then finally, getting our sales teams to work better. Capita's always had a good reputation for winning some of the big, sexy deals. But actually, what we're doing better now is also getting the smaller deals to help support that. So 70% of what we won in the first half was contracts worth less than 10 million. And obviously that increases. It tends to be more transactional, so it's kind of in the nature of things. But 86% of our target to deliver our revenue growth in the second half will also come from smaller deals. And a lot of that is part of that new business model and driving efficiencies out of that. A core part of what we need to do is make sure that we are a competitive player in terms of our digital capabilities. This is things like automation, cloud migration, AI and data analytics. It's also an area where government in particular is focused. Earlier this year, they committed to an additional £8 billion of spend in the next 4 years for their digital and data roadmap. In the public division, we are sort of leveraging the technology stack using global suppliers such as Microsoft, Salesforce, and Amazon, so that we can start driving solutions from that. Experience already has a very competitive platform, and it's about industrializing how we use that platform to provide services for our existing and future clients. And obviously you can see there a list of the people for whom we deliver digital transformation services. Next couple of slides have examples of what we're doing here. So the Turing scheme is an interesting one. We leveraged a grants solution that we developed using one of the mainstream platforms I just talked to, and have started off with the Department of International Trade, but then saw an opportunity where the Turing scheme, which is the replacement for Erasmus, was looking for a grant distribution platform. The incumbent was failing, and we stepped in, and we've done a good job, even if I say it myself, on that in the 2022-2023 process, which is more or less just finished or is just finishing now. In terms of HMRC, again, we've become their automation partner. We've stepped in. Again, they had a big name doing it before, and we've taken over. And again, I think we're making good progress there. So 2 schemes in government where our digital capability is proving to be successful. In terms of the experience division, again, we've got an electronics client where we are delivering on all of our operational and client KPIs, and we're very proud of what we're doing here. So the customer satisfaction scores are good. The NPS scores for the clients who work there are good. And generally client satisfaction is good. I think what's interesting here is that 98% of the people delivering on this specific contract are working from home, which will potentially help us when the sort of the business model gets rolled out in future. It just means you can access people from all over the country. People can work during times that suit them, gives them satisfaction, it helps them deliver a better client service. So we are particularly proud of this particular client case study. One of the key things we still need to do in the business is drive the underlying margins of the business. And I mentioned earlier, sort of EBITDA is expected to decrease a little bit this year, but we see scope to increase it significantly over the next few years. And it's the margin improvement in the business that will help drive cash generation, which will help make this a successful, positive free cash flow generating business in the future. So the first part of that is operational excellence. And as I said right at the beginning, this is a business that lost tens of millions of pounds of both profit and cash when it was failing on its big transformation projects. All of our major contracts have been executed successfully this year. Royal Navy, Defence Fire and Rescue, Scottish Power, and the STA scheme. Although I think we'd say we could have done better on that still. And again, a lot of this is part of the disciplined contract bidding and contract management, which we now deploy into all of our contracts, and part of the delighting our clients purpose we have in the business. Secondly, we have continuous improvement. And this is where, again, it'll probably take a year, 2 years, perhaps 3 years for the real benefits of our new model to start sort of shaking through. So we are deploying across both experience and public much more integrated delivery and using best practice across the business. We're deploying standardized delivery tools and processes, again, which will help us be more efficient and successful in our contract delivery. And then sort of using the geographic platform that we have, using the UK where it's important to use the UK, but then India is a major development hub for a lot of our IT and software. South Africa has a lot of the customer experience capability, and we've got more volume capability to deploy there, which will help drive margins. And then finally, investing in new places like Bulgaria, which will help deliver our language capabilities for the clients who need, particularly across Europe, the wider language skill set. Reducing our property footprint is a key driver of cost savings. It's also a driver of lower net debt, because if you remember the sort of the lease, capitalized lease elements that are in the post IFRS 16 debt calculation, as we reduce our property portfolio, our net debt will also come down this way. So we've reduced our property footprint by 25% over the last couple of years, since the beginning of 2020. We've got another 18 that we disposed of in the first half of this year, and we got out or vacated another 9. And this is something that we'll continue to see decrease, and we expect it to come down another 20% by the end of next year. And then finally, the overhead. So if you look at those first 3 as things that will improve the margins of the divisions to help us achieve those divisional targets of probably low double-digit EBITDA margins, the overhead and the shared services are an area where we continue to sort of see efficiencies. So, excuse me, further efficiencies from the shared services, things like what is it? It's finance, it's HR, it's IT, it's software development. We're still integrating those into our delivery, and then the group overhead, where we're doing things like improving the structure, which takes out costs. So the number of legal entities have reduced significantly over the last 4 years. Inflation is a key topic, I think, amongst a number of investors. As I kind of indicated earlier, we don't expect to see a material impact in 2022, mainly because of the timing and the sort of the relatively low impact in 22, mainly because some of the drivers sort of came out of 21. So what do I mean by that? I mean that government contracts tend to the new clauses take effect from about April, which is when a lot of them would start. April will have used a H2 21 or a Q4 21 indexation number, and will have only applied things like salary inflation from the second quarter. So that's why it hasn't really had an impact in the first half of the year, and it will still have a relatively low impact in the second half of the year. Why are we confident that we can manage it? Well, 2/3 of our contracts have indexation. A lot of our business is transactional. So again, transactional revenue, we update the rate cards more and more regularly. And then where we need to do a little bit more, we are educating people who haven't had to do this sort of thing in 20 odd years, in discussing with clients how you can improve services through price increases. So again, it's a mature commercial discussion that sort of says that if we need to increase our prices, that will result in a better service rather than sort of someone potentially going off and working for someone like Amazon instead. So as I say, generally we are protected, and in those few areas where we're not, we're taking active steps to make sure that protection is passed through as well. As I said right at the beginning, one of the areas that we wanted to address this year was the tight employment market, particularly coming into this year. It was the tightest market in 50 years. You had the Great Resignation. Certain parts of the market were very hot, such as IT. And we think we've done a very good job so far this year in starting to address that. So we're investing in Capita being an attractive place to work. So things we're doing around training, development, personal well-being, all makes it a better place to work for incumbents. Things like the working from home that we talked to on that earlier contract in the experience division in particular is highly attractive to people. So we are seeing much better recruitment. Last month, our recruitment target, we exceeded our recruitment needs, which is a good thing. Our employee net promoter score, as I said earlier, is also significantly improved. And so our employee position is that we have the people we need to deliver. We need more people to be able to grow the top line. I think it's fair to say there's a little bit of money being left on the table insofar as we could grow even faster if we had more people available. Hence, things like opening a delivery center in Bulgaria, where we can drive particularly sort of multi-language capability. So in terms of the disposals and the portfolio division, this is all going well. And if you remember back in March, we said we had a number of pillars we were disposing of businesses through. In terms of the process, that was partly to make it a bit more, just simplify it. As we saw with a property pillar, every once in a while, a particular business is seen as being more attractive to an individual buyer, and they will not therefore all be sold in their complete pillars. But it's going well. So technology, the Trustmark business we sold earlier this year. We announced the property disposals in August. And then some of you may have noticed we've also just recently sold the Optima business. Pleasingly, Friday's news was we'd sold Pay360. And if you recall, so this is something we announced back in August, although we've been working on it for a while. Pay360 currently sits in our experience business. It does work for both experience and government, but as a software product, as a payment tool, it was something we debated whether or not ever really belonged in Capita, and we took the decision to sell it. We're very pleased with the price we've achieved for that. And again, it's a significant chunk of cash that will help pay down the debts, the net debt in the business as we go through the next 12 months. So, I mean, where are we going to end up at the end of this process? So, as I said, we're going to have launched all of the processes by the end of this year. We expect to have announced the sale of a fair proportion of them, and some of them will still be left to close next year, but that will leave us with no material financial debt. Also worth flagging that some of the proceeds we agreed with the trustees as part of the last triennial valuation. Some of the proceeds will go towards prepaying those outer year pension payments that we're committed to. So we're committed to sort of 45 million from 2024 to 26. So that will just mean that the balance sheet is even stronger as we go through that disposal proceeds. So the next triennial valuation, hopefully we're in a position where there is a surplus in the fund and we don't need to make any of those further outer year pension payments, thereby increasing our free cash flow. And then finally, property rationalization, as I just mentioned, will drive net debt down at a post IFRS 16 basis as well. So all in all, everything heading in the right direction for a period of very low stroke no financial debt by about half year next year, which gives us options. So we've sort of committed to a net debt to EBITDA target number of about 1 times. So we'll be below that, and therefore we have the ability to redeploy capital in ways which we think will generate the most value going forwards. So in summary, as I said, the key message was first half in line with our expectations. We continue to embed the new operating model, the future Capita structure. So by the end of this year, we'll be in a very strong place to go forwards. That helps us drive revenue opportunities and grow revenue, helps us build a portfolio of better quality contracts. That's an evolving process. As I just said, the inflation risk is being mitigated and actively managed. And we have further opportunities to take costs out on an operating and an overhead basis. And then finally, our delivery, the delivery of our disposal program is going very well, and we expect material reduction in net debt as we go forwards. So feeling very confident and positive about where we were and how we're going forwards. And Capita in 2023, once we've disposed of that portfolio division, will be a business that's very focused, growing the top line, targeting positive free cash flow going forwards, with a very strong balance sheet. And on that, I will leave it open to some questions. I will stop sharing.
Stuart, thank you very much for those encouraging updates. Glad to hear that the recovery is well on track and you're looking forward positively to the future. And just a reminder to everyone, if you do want to ask a question, please type it into the Q&A box, which will either be at the top of your screen or at the bottom. Let's start with some of these questions here. So the first one around net debt levels at the end of FY 2022. I think you may have sort of covered it, but let's have a bit of clarity. So question is, knowing that the cash flow headwinds, including the pension contributions and the VAT deferred payments, are a lot lower this year than 2021, and assuming that the Pay360 transaction closes in Q4, do you see a pathway for net debt to be negative, i.e. you'll have the net cash on the balance sheet?
As I said, we're going to be very cautious in terms of our guidance here. It could be, I would also pose the caveat that Pay360 requires FCA regulatory approval. All of our disposals will require some sort of regulatory approval. Because Pay360 is a regulated business, the FCA can take a while to do it. However, as you said, if the cash is received by the year end, yes, it will come down substantially. But as I say, I hesitate a little bit to commit to any particular number. But as I said, if we got 290 million at the half year and you're taking off 150 million of the Pay360 proceeds and the property proceeds, it will come down significantly. Also, with the note that some of that cash will have gone to the pension scheme as well. So whilst net debt on a pro forma basis might not come down quite so much, the strength of the business and the ability to generate positive future cash flow will have benefited as well. It's a bit of a sort of a holistic thing that sort of says, look, the lease debt's coming down, pension debt's coming down, financial debt's coming down. All of those will mean that, let's say by 30th of June next year, there's no financial debt, but also free cash flow has a significant benefit to it.
Okay, thank you. And then digging into a little bit more detail on the debt side, are the private placement notes that should total circa 295 million at the end of this year, after the 139 million pay down in November, callable early, i.e. can Capita redeem them sooner than their maturity dates?
We can. That tends to be expensive. Although we will look at redeeming some of it as and where possible. So you might end up with a situation where you have zero net debt, but you still have a little bit of outstanding notes because it's not financially worth redeeming them.
Okay, thank you.
Economically worth redeeming them.
And because you're making so much progress, I guess, on the debt side, we've had a couple of questions come in here on dividends. One is, do you have a timeline for introducing dividends? And the second one is, are you going to pay a dividend in 2022 or 2023? So maybe you could cover the dividends and your thoughts on that.
So our thoughts on dividend and our general sort of capital allocation thinking is, when core Capita generates positive free cash flow, that's a stable business when it would be sensible to start thinking about sort of returns to shareholders. Our ability to do that in 2023, so I think it's highly unlikely we'll do it in 2022, as in we won't. Our ability to do that in 23 will depend on our ability for core Capita to generate positive free cash flow. As I say, the contribution that the portfolio division makes this year will fall away, and there's still more improvement to be done before that happens. I think, look, the market expects the number to be sort of break even on a sort of core Capita basis next year in terms of free cash flow. If we can achieve that, then obviously it's something we can think about. I'd suggest it's probably more likely in 24.
Okay, thank you. Again, we've had a couple of questions on this in the past, and we got a couple of questions on this topic today. One of them is, have you been able to make any progress with getting some research available for private investors? And the second question related to this is, what are consensus expectations from the analyst community for sales, profits and cash flow this year and next?
I'll take the second point first. And I'll say, look, it's a very complicated picture because you've got some analysts who are modeling core Capita as it stands, and even there you've got various degrees of who's taken out property, nobody's really taken out Pay360 yet, as far as I can see. So you've got that core modeling, and then you've got a couple of analysts who've decided that they're just going to model core Capita to avoid that sort of perception of endless profit downgrades as you sell businesses, which I think was part of a sort of a factor in last year's kind of those downgrades being sort of fed into the share price. So if you're looking at the sort of current scope of the business, revenue is expected to go up at about 4%. There's PBT of 91 million but that's pre any adjustments for property and Pay 360. Free cash flow consensus is about 30 million, and net debt on a post-IFRS 16 basis is about 670 million. So knock off the 400 million of lease payments, and you can see where you get to on a pre-IFRS 16 basis. In terms of the core business, you're looking at revenue growth of about 3 million, PBT of about sort of 54 million, again, pre the Pay 360 adjustment. Remember, Pay 360 is inexperienced, so there will need to be an adjustment for that. Free cash flow expectations are about flat, and net debt's about 570, again, pre-disposals of, or pre-360, Pay 360's disposal, and there's just an assumption there that you're going to get, there's a full portfolio disposal, but you receive some proceeds this year and some proceeds next year. So looking at the sort of the numbers there, they are what consensus is. The analysts have a range of assumptions they're making, so I'm reasonably comfortable with them on either basis, but they're not quite up to speed with events. In terms of the research, still something I'm looking at. I'm talking to a couple of people who might be able to provide independently provided research, but it's something that I apologise here has been slightly on the back burner for the last couple of months.
Okay, thank you. Question here: are you managing to rebuild institutional interest in the shares?
Yes, we've seen a couple of institutions start to buy shares in the last few months. I would have to say that some of the they tend to be some of the more entrepreneurial institutions who have a slightly higher appetite for risk, but we are making progress there. And again, referring to something I sort of said a bit earlier, the view I have is come March, when we've executed a successful 22, or we've disposed of the portfolio division, and it'll all be at least held for sale, if not actively disposed of by that point, and you've got a clean view of what the business is like going forwards with no debt on the balance sheet and potentially sort of positive free cash flow, that's when I expect to see quite significant institutional interest. I suppose the other observation is sort of the UK mid-cap fund manager is quite under pressure at the moment. So there is a challenge right now to be able to sell them Capita. I'd expect it to be a more interesting proposition in 6 months' time. Okay.
Serco and Mighty have done some significant buybacks, which have driven quite big share gains for those shares. Now, currently, Capita is on half the EV to sales rating of Serco, even though John Lewis, the CEO, thinks that Capita is potentially a higher margin business. Would you consider buying back shares once more cash comes in?
Yeah, so I refer to my earlier answer on dividends. When Capita is generating sustainable free cash flow, we can afford to do it. At the moment, the cash we generate is going towards paying down debt. And look, if we're going to a recession, I would much rather have a very strong balance sheet and to potentially sit there with a very strong balance sheet for a little while than doing share buybacks, because Capita needs to have that sort of period of stability. And as I say, maybe we start to look at some sort of capital returns in 2024.
Okay, thank you. Got a couple of questions here on margins. One is sort of more general. Can you give some indication where margins might get to in both divisions? And then the second one, which sort of linked to this, is Capita has got some large gross margins comparable with other large global players, but much lower operating margins. And how much scope is there to take out more SG&A to get those operating margins up further?
So I think both divisions have opportunities to increase their margins. The public service division actually makes pretty decent margins for a public sector business doing what we do. As we move up the value chain, as we increase the amount of sort of digital capability we have, there is margin opportunity to increase those gross margins. Similarly with experience, if you look at some of the global peers in experience, they make very attractive margins. But part of that is because they are global businesses. So the experience division has sort of a two-step approach. One is to make it more efficient on its current footprint, so mostly UK, a little bit of Europe, at which point our target is sort of high single digit to low double digits, to start sort of leveraging that, so you get the operating gearing off growing margins based on growing revenue on a fairly fixed cost base. As you start to win more revenue, that's where you'll start to see attractive margins in the experience business. So yes, both divisions have more opportunity on a gross margin basis, but then absolutely there is that overhead and SG&A and sort of shared service component to it that says we can be more efficient. We're still embedding the operating model to a degree. So there is more efficiency to come out of some of those shared services and the divisional overhead. And then, as I said, also the group overhead is still too high, and there are structural opportunities to come out of that. So if you sort of look at improving gross margins, improving operating divisional margins, and then improving the group margin, there's a sort of very clear pathway to be able to do that.
Okay, thank you. Can you explain the lack of director purchases given the current share price being near an all-time low?
I think you've had a number of director purchases over the years. I mean, if both John and Tim have bought a reasonable amount. I think John has bought a lot to start with, and has continued to buy through the last few years. So it's not as if they aren't buying, it's just they buy from time to time. David Loudon, I think our chairman, bought some the other day. I will continue to press the board perhaps to look at further purchases. Okay,
thank you. Question here, what is the conversion rate for projects in the pipeline?
So I spoke to the win rate at 42% earlier. So that's on contracts we choose to bid. The conversion rate is significantly lower, probably around 10%. And that's a number that again, there are two elements to it. One, obviously, is we want to win more of that stuff, and we'll win more as we become more focused and more competitive. But also some of the quality of the stuff that gets put into the pipeline. So we implemented Salesforce a couple of years ago. The quality of the pipeline we have is now much better, and that's a process that will continue to improve. But it's mostly the former. It's making sure that Capita has increasingly competitive products and services that it's putting in front of both existing and new clients, particularly new clients. Okay, thank you. Another question here on disposals. Given the portfolio division is growing and has high EBITDA margins, is there scope for disposal proceeds to exceed expectations? Even after the disposal of Pay360, it looks like there's up to 200 million of revenue still left to sell at low double-digit margins. This could fetch a good multiple, which could push you into a significant net cash position once proceeds are received. We are always trying to achieve the best price for those businesses. There continues to be interest in them. I'm not going to comment on a sort of particular valuation or number of proceeds, but there are still, as you just said, some interesting assets there. Our travel and events business is still recovering from, firstly, COVID, and then secondly, some of the sort of stuff like train strikes that go on at the moment. So it's a business that we restructured. It doesn't need all of the volumes that it used to have pre-pandemic to be able to make the same amount of profit. But I think the timing of the disposal of that business will be whether someone sort of looks through the current kind of variability of that and pays a valuation, a price that reflects its underlying quality, What else? You've got some good quality businesses, as I say, across the board. We'll try and get as good a price as possible. As you say, if we get the more cash we get, the more that goes towards reducing debt and improving the balance sheet and the strength of the business.
Okay. And continuing on the proceeds or the disposals, have you had bids for parts of Capita that you do not want to sell?
Not that I'm aware of. Everybody knows that we are selling lots of bits of our business, but no, it's well, look, I mean, every business is for sale at the end of the day. So if someone was to come along and offer a price for the whole business, part of the business or whatever, we'd look at it. But no, we haven't, as far as I know.
Okay. And finally, I think we've got time for one last question here. Liz Truss has spoken about privatising big chunks of the civil service, passports, DVLA, etc. Could this create a significant additional opportunity for Capita, as this would require meaningful outsourcing?
We're pretty positive on government, although it's very difficult to say absolutely what's going to happen. Obviously, we've got Liz Truss's newly installed. You've had the hiatus of the last 10 days with the Queen, and then before that you had the Conservative leadership process. So not a lot has gone on in the last couple of months in government. However, as I said, they've committed 8 billion to digital. I expect that to stay. They need to deliver more efficiently. They need to deliver better customer services, citizen services. They've said they're going to focus on areas like the MOD, which is where we have a big position. So if you look at what we do as an outsourcer, where we do it, I think there's strong potential working for public sector. But let's wait and see kind of how that pans out, perhaps in the next few weeks and months.
Brilliant. Well, on that note, Stuart, thank you very much for presenting today those encouraging half-year results. Thank you for everyone who's attending. I will note there is a survey as you exit today's webinar. We really appreciate it if you could complete those survey questions. And again, just like to say thank you very much for everyone for attending, and we hope to see you all soon.
Thanks very much.